Hello, and welcome to the latest Skadi podcast, where we go into more depth on our monthly Horizon research piece, as we're tentatively calling it Horizon Unpacked. My name is Damian Taylor, and for those that aren't aware, here at Skadi we produce a monthly research piece that is aimed at the control functions within both financial and non-financial institutions. The research looks to cover current and future challenges and potential areas of focus for the control functions. Previous versions of Horizon are available on our website at skadilimited.com. Plus, if you want to read more about the thinking and planning that goes into each of these monthly pieces, please join our Discord channel, which is full of fantastic resources and insights. And with that out of the way, please enjoy the following conversation with myself and Nick Corry on the October 23 Horizon, which covers CDS, binary and digital trade structures, and securities lending.
Just released the October Horizon edition, and we thought that while Horizon is a quick read, Damian, I'm sure you'd agree.
Yeah, absolutely. We try and keep it to 2-3 pages. If don't really want to be a 70-page document that no one ever gets through.
No, absolutely. The point is we are trying to be forward-looking but thought-provoking. But sometimes it can help to just unpack some of the stuff that we talk about, because while we are trying to keep it nice and tight, we do also, it's a meaningful, we're trying to raise meaningful stuff. And finance, on one level can be quite simple, but on other levels it can be quite complex. So we've hit on, I think, a couple of really interesting topics this month. The first one has been troubling Damian and myself, I think, because what we recognise is that it's possibly something that is going on in the market on a constant basis. It's possible. It's entirely possible. We have this hunch, don't we?
I think that's a fair enough description of it. Yes, I think it's. I don't think we just plucked it out of the air randomly. I think we have thought about it a lot. I think it's. Well, you ought to really reveal.
Well, the big reveal, we're talking about the fact that, binaries, digitals, barriers, whatever you want to call them, traders face temptation on a daily basis on any kind of opportunity to make, a big windfall. And that's human nature. I mean, I wander around most days thinking about how I might win the lottery. And the difference with these products is that they do give... or they do provide the possibility for that kind of lottery-style payoff. But, of course, traders wield a lot of power over their own positions. And so with these products, which have, the potential, some of them have the potential to have, characteristics which need to be hedged legitimately. So I'm thinking about, sort of digital barriers, that kind of stuff, where, there are necessary orders to hedge against those. And then there are just other products, which is just purely about getting, getting a price of an instrument to a particular level at a closeout, for example.
Yeah.
So, you and I were kind of brought up on... I remember we used to trade the FTSE, and if you remember, there was the kind of, and I say you remember, maybe it still goes on, to be honest. I haven't looked at the FTSE future in decades, but obviously we were very active in that. But if you recall, on, what do they call it? I can't even remember what they call it now.
Third Friday?
Well, it was a third Friday expiry, but it was called something, that kind of window where, suddenly all these baskets of index constituents would be traded. And we were also there at a time when, the SDX line would start ringing because people would be trying to get, and they were trying to get an outcome. They weren't necessarily looking to purchase or sell. They were more looking to drive the price away.
Yeah, it's been a long time since I've looked at the FTSE. I think that was it now is a midday auction. I don't think back when we were trading, I think sets had just come about prior to that, obviously it was completely order book driven, but it became much more electronic sort of in our earlier years. And yes, people, the fix would be calculated by the closing average of the 100 constituents at that time. So people would be coming in quite large size, because if you could move the biggest stock, which would have probably been back then being Vodafone, up a few ticks, well, that would move the whole index, which then changes your strike, which then changes any products that you've got written around that. So yes, I mean you're right. The lines would start to ring quite heavily around that time.
Absolutely. So what's really caught our eye is the case of Neil Phillips, which has been going through the courts recently, who was with a hedge fund and was in a currency product against, I think, Morgan Stanley. And this had an expiry in January, but it led him to execute a strategy during Boxing Day.
Yeah, so just to it was a knockout type option, so it only had to hit it once.
Yeah, so it was a single touch.
That was it. That's the word I was looking for. So it's not like on that day, the 4th of January, if it was X or Y, it just had to have hit.
I think at any time during the life of the product, and it was the South African rand against the US dollar, and he undertook trading via Singapore. So you kind of have this confluence of possibilities to enable him to conduct, what was bluntly a market manipulation. Clearly, Boxing Day is a low volume day. You're looking at a cross rate, South African rand, US dollar, being traded out of Singapore. It's completely the wrong region. And of course, traders aren't going to have the appetite to stand over South African rand risk. Why would they? And so they will be, it's an opportunity to push something a little bit harder than it would ordinarily move.
Yeah.
But where his activities were uncovered, really, or his undoing, was in the blatant evidence he left in the communications. He was giving instructions to sell until it hit a limit. His desire was to move it to a limit, and that's why in the sort of the transaction monitoring around this stuff, the ecoms are really, really key, because it's very difficult to really differentiate between manipulative practices in some of these products and legitimate hedging. So you will have one side or the other defending and attacking these levels. And I guess my hunch looking at this stuff is that this was only uncovered because his activity took place on Boxing Day in the South African rand, traded via Singapore. And it's just sort of, it kind of sticks out like a sore thumb, let's say. And I'm just wondering whether actually the fact that, more of this stuff probably goes on a daily basis in the marketplace, but no one really is aware of it from the control function side. Maybe it's very difficult to monitor. And unlike other stuff where you would have, one side or the other calling out behavior, I have the sense that everybody's kind of at it. I think that everyone is sort of on both sides of the transaction, kind of knows this is the turf, this is what you do. And it's a kind of dirty secret of the market. Yeah. And it's a sort of honour amongst thieves, maybe.
I think that's probably right. There's always fun and games around expiry. Everyone knows that. And everyone, you read a lot of blogs out there, they will talk about, there's a lot of gamma in the market at this price, or there's lots, the fix, there's the danger around a fix around here, or there'll be people defending or attacking that this certain level in the S&P or whatever it may be. So yeah, I think you're right. It's possibly just a dirty secret that carries on. Even though people know.
Yeah, and I think probably at the larger houses, the risks are probably more recognised because as you say, there's a lot of gamma around this stuff, and actually there's so much gamma around this stuff that it tends to blow up the risk systems. And we worked with one customer, and this was many years ago, probably a decade ago, looking at the problem around barrier options and whether that it would be legitimate to have a process where you could adjust the market risk, the static data behind a product, to enable you to suppress that gamma so that the rest of the risk of the book could be seen. And it was just, acknowledged and accepted. There's huge gamma in this position because we know about it. It's there at expiry. But that's the point. Everyone knows about it. Yeah. Transaction monitoring are all over it. And I think transaction monitoring has come on a massive journey in the last decade. But I would be concerned where you may have institutions, maybe some of the smaller ones, where actually some of this stuff could be taken out of the static data, adjusted by the front office, and people in the control functions aren't made aware and just aren't aware. And so therefore you get all kinds of trading which takes place, which no one's really monitoring and no one's really looking at. So that was kind of the sort of the first concern around, that's the, if you like, the kind of the traditional products, which I think were well recognized, but I think actually what the press is telling us is, there's a few things out there that might make people think, well, maybe we need to go and refresh some of this stuff and have another look, because we haven't looked at this stuff for a long time. We've got a lot of, juniorization that's occurring as well, if we're honest, and you may just have people who are not as aware on practices and what they should be doing. Well, that's great. The lights have gone out.
Worked out. We need to change that. We need something to throw across the room.
Yeah.
I think we'll carry on.
No, I think we should just carry on anyway. But it'd be interesting to see what.
But just rewinding slightly on what you were saying. Obviously, you said that the key that it being picked up in the Phillips case was that it was on a low volume day. So hence it would have probably stood out on transaction monitoring type systems. But I wonder, and you may know more about this. You've been in investigations more recently than me. How easy is it to align market data with voice data, with Bloomberg chats, etc. data? I think, as you say, systems have moved on a lot, so maybe that is the norm now.
Yeah, so it is quite normal now, and there's a lot of systems that just do that. They and if you look at the fixed income market, around something like an RFQ. You have transaction monitoring which takes place from the point at which a request for quote, an RFQ, comes into a firm, and the transaction monitoring will follow, three pathways. It'll either be until that trade is executed, it'll either be until that trade is cancelled, or it'll be until that transaction is timed out, or that request is timed out. So it is very reliant on, obviously, people booking information. There are, no system is foolproof.
Yeah.
And there are ways around stuff.
Yes.
And so, of course, in this case, if you're the bank in question, you have no line of sight over a customer's communications. And so you're reliant on, a third party, because I'm thinking back to the story, but effectively you've got London hedge fund, you've got Singapore executing dealer, and you've got investment bank on the other side of the transaction themselves. Now, what you and I know, Damian, from trading is that in most products, even probably most commoditized, if you're in something, you get the sense that other people are acting against you, and you have a sense of what is, when to cry foul, effectively, and when you've been burnt on something, or when something's just doesn't smell right. And my sense is that on this particular one, that's probably what happened. And I think probably the traders the position takers at the investment bank were very, very, very clear as to what happened, because they suddenly faced a big loss. But I do also understand, looking at the reporting, they themselves had done a vast amount of transactions around the barrier on that day, in defence. Or was it legitimate hedging?
Yes.
And this is the point. But where Neil Phillips is undoing was in the e-coms, in the communications. And, you and I actually experienced a situation ourselves when we were way back at ING. We had a very, very aggressive sales trader who took an order from a customer and then discussed with traders in Amsterdam who were, naive and probably juniorized, a bit like what we have now in the marketplace. They discussed about how to get a stock to a particular level on an index expiry for a customer. And they had to go. And it's that kind of, again, it's the discussion, it's the motivation, etc. And that's where, things are going to get uncovered and be able to be determined. So that was one particular instance that we were looking at. But then the other one that I wanted to look at, these are all sort of examples, I guess, from the equity market, although that was from the FX market, South African rand against dollar, I think it was. It's really looking at the fixed income and credit markets, because you don't have the transparency in those markets. And we're also in a phase, I think everyone would recognize, where next year the market is going, if it carries on its trajectory, things are going to get harder, and we're going to be looking towards, we've got a very, very steep refinancing window. We're looking at potential insolvencies and people running into difficulty around stuff. And with that, you've had the resurgence of credit protection products like CDS, for example. We've talked about CDS in the last 3 horizons now, and that's not because we're sort of trying to push something. It's just the fact that it's come over the horizon. Yeah. This was a certainly single name was a product that had kind of died a little bit of a death in the kind of benign markets of the last decade, and it's had a resurgence. And with a CDS, yes, it's this insurance product. It's there to hedge against your debt, and they're all deliverables into this contract and so on. But when the music stops and you get into a situation where there is what's known as a credit event, which is a bankruptcy or a missed payment, some kind of technical default, a bit like the Hovnanian situation a few years ago, with a sort of engineered technical default I think it was on a coupon, then you have an auction process which is there to help the market determine what the payout on the CDS should be.
Well, one, if an event has occurred,
as
in technically it has then moved across a whatever barrier, whatever that may be, to become an event, and then, as you say, yes, and then you have to clear that product, so there will be a clearing price, in the pennies or cents, whatever. But that determinations committee will be part of that.
Absolutely, and you've got a lot more CDS in play than there are bonds underlying it. That's just the nature of it now as a speculative product, or you can have, and that really creates a very interesting dynamic with a lot of vested interest. And again, vested interests. This is a binary payoff situation. Either these CDSs are going to pay out or they're not.
Yeah.
And it's and the question of how much. So you can have attempts, successful or otherwise, to circumvent the auction process. I.e., someone just comes in and bids for all of the debt and prevents the process from occurring. And that's also a risk where you have index products, so CDS tied to indices or forming part of a basket and so on, where if you attack that, if we call it an attack, because I think it's an aggressive act, it's the right kind of language for this kind of stuff. If you identify and work out that you can prevent the wider index product from reaching or being effectively unwound and working through that process, then you can circumvent the entire process for bidding for a block of debt. And that seems to have happened in a situation between Carl Icahn, the kind of legendary, if you like, but long-standing investor over a shopping mall in Albany, and a hedge fund, Canai Investment, which was in a joint venture with Morgan Stanley, an investment bank. And investment banks do tend to be sellers of CDS. Yep. Not saying in this case that CDS, that Morgan Stanley had a big CDS position. It could easily have been the fact that this was a distressed Mall and Morgan Stanley's distressed business was interested in it. I haven't been able to read into this situation enough to really get into that kind of detail. But you can see that in a lot of these situations, you have a kind of activist hedge fund or investment management protagonist, but quite often they're linked to, an investment bank behind them, or there are some kind of links, whether it's financing or JV, and that always raises the question, certainly in my mind, as to what's the ultimate motivation here, what's happening here, and that's where I think that the control function should really be thinking about this stuff and be alert to this stuff, because if they don't catch it, and of course, it's first line that should be on this immediately. This stuff shouldn't be happening in the first place.
Yeah.
But second and third line have got to be on this and open to the possibilities. Otherwise, what will happen is you will get a situation that slips through all of the safety nets. Customers of the bank will get, burned, will get fed up, will feel like they've been treated egregiously. And the result is an expensive investigation,
huge fines,
expensive litigation, and reputational damage. And reputational damage is really on the rise this last year. You can just sort of see the swing in things. There's a kind of narrative. And of course, we all remember what it was like 2008, 2009. It wasn't nice to be a banker, was it?
No.
And I feel like we're getting back there. We've got a couple of elections coming up. Bankers are easy targets for politicians.
Yeah.
So anyway, that's the kind of we've yabbed on enough about the kind of the binary risk, but certainly I think that's an area that people should be looking at and focusing on in the next few months, and certainly into the next year with some of this credit stuff. And then the other one was really about the stock borrow market.
Yeah. So we looked at. There's been a rule update from the SEC. It hasn't come into effect till 2025, but yes, it could have quite big ramifications for stock borrow desks. They will need to report data a lot more quickly than they have been in the past. So they will have to report deal terms by the end of close of business that day, and then some of that data will be released the next day, and then some will be released in 20 days' time. But it will increase a lot of transparency in the market, but could bring with it additional risk.
I'm all for transparency in the stock borrow market, Damian. Having a convertible bond trader who, obviously, these kind of products, you end up borrowing a lot of stock. And you and I were on risk arbitrage books and stat arb books, basically anywhere we have a short. And it was always very, very difficult, I found, to get any kind of information.
Yeah, there's nowhere printed currently where you can actually see what rates are that you're borrowing. No. And you could. A lot of names are very easy to borrow. If it's a big index holding, it will be held by the big index players, therefore it will be lent out easily. But it's certainly, especially with a risk arb hat on, they're sort of lower tier deals where you need to get short the acquirer, and you don't have much transparency on what the rate was before. Someone might lock up a block very quickly and suddenly it was available at 3% and it's suddenly trading at 10%. But you don't, you might hear that from hearsay, but you wouldn't hear that. It's
a very difficult market to be aware of from the outside.
Yeah.
Because although it was an integral part of our books, and I think also when you're trading some of that, like convertible bonds, because it's part of the option pricing model, the assumptions around borrow, you're probably a little bit more on it. But I think, when I think back to where we were, trading more of the kind of the pure equity kind of, relative value type stuff, I remember fiat. That was a name that got very, very difficult, in the noughties. And you had, like you said, like 12, 15% to borrow that name. Obviously, fiat's still going strong now. Great. So whatever was going on wrong then has been solved. But also you've got different kinds of pools of borrow that are, more stable, less stable, index arb borrow, all that kind of stuff.
Well, and converts borrow. So if you think you'd look across a line of stocks, or a retail punter might look at a line of stocks and go, well, look, there's the short interest in that stock is 20%, not really realising that there's actually quite a big convertible bond in that name, and 15% of that is locked up as part of that trade.
You're hitting on the kind of the GameStop phenomenon, aren't you? Because that's how GameStop really kind of became a kind of name for the Redditors, wasn't it? Because someone did the work
and worked out that there was an a huge amount of short interest. And I think at one stage, someone worked out there were more shares shorted than there were in existence in that name. So, and I think this has been the push certainly to get the SEC to act was slightly retail led in a way, because I think the feeling was nobody really knew what was going on in these names. There was sort of a lot of hearsay about how much stock was shorted, but actually this should hopefully increase the transparency, but could bring with it knock-on effects that we will have to see how those pan out in the next couple of years.
Well, I think also it's a really interesting situation because, of course, we only look at it from the side of the market as someone who's been borrowing stock.
Yeah.
Now, of course, maybe there's going to be some friction when those static pools of stock, the pension funds, etc., find out just how much margin has been taken on some of their holdings. I'm not saying that is the case, but I just wonder. So it could. I mean, I'm all for this. I'm all for it because I think this could be really, really good for transparency, really good for efficiency. Driving down costs. If you drive down the cost of borrowing the convertible bond model, you make them cheaper. Then they are a great source of financing for issuers, and that this is all to the benefit, generally. So I think this could be a very, very good move. It shines a light onto an area of the market that's probably been dark for too long, if I'm honest. So I think it's going to be really interesting, and we've got other interesting moves in the stock borrowing market as we kind of go to press, if you like. Saw that South Korea have put a freeze on short selling, and that of course means therefore lending of stock is going to be less in need, because if there's no short selling, there's no need to borrow stock. So that's going to have a knock-on impact as well. So it is an area that different regulators are looking at, maybe for different reasons, but it generally is an area maybe that needs a little bit more scrutiny from the control functions, just having a look at some of the controls and what do we do? Are we able to make commitments on what we're saying to customers around some of this stuff? And do we have the ability to meet the reporting requirements? Because I think it's about 12 different items they've got to report on.
Yeah, not just the name and the amount. As you say, the rate. I think where it was dealt and all this sort of, as in which venue it was dealt through, etc.
Yeah. Terms of funding. And interesting. Well, I think that takes us to the close of this. It's a quick read, and we'll do a quick unpack. Thanks a lot for joining us. This is the first Horizon Unpacked, and we will be with you next month.